global investment in climate tech has tripled since 2015, but we need more investment from statistical data, public investment. That means from government funding. China is the #1 ahead of other countries. Europe, if sum up all the countries' investment, actually is twice of US government's investment. That's 2021's data. But of course, US now has the IRA. So also in other area about VC funding. VC funding is part of the financial source of this climate tech ventures. US received the largest portion of US VC funding, more than Europe and China, is 41%. So I always hear about friends in Europe or Asia. They say, in general, startups need to go to the US. There are a lot of reasons. But in climate tech, I think today our speaker, Juan, can give us a good picture of this US landscape of climate tech investment. So a little bit of who we are and what we are doing. Globally, its slogan is Network of Intelligence. It's a vetted network. It's free to join. We are a network for accredited and professional investors to collaborate on startup evaluation and deal syndication to identify and help the most impactful ventures. We are always spending. We will reach out to industry experts, investment experts to evaluate deal together. So being a fellow can always get deal flow, engage in evaluation, and then identify the best deals. We collaborate across boundaries of accelerators, VC, angels, and investor groups and geographies. Later, I will paste the link to the chat. So this climate tech investor panel is one way of our doing this network of intelligence. So every Friday, we will interview experts, investors in this climate tech investment. Climate tech investment is hard, mostly because it's deep tech, but also there are a lot of variables in the environment, in the ecosystem, in policy, and the whole value chain are still evolving. So that's why we are doing this, because investors need to have more data, have more connection to be able to make decisions. Okay, now let's get to introduce our great speaker today, Juan. Juan has long year experience in before become an angel investor. He has been in sales, marketing, business development, customer-facing management, and since 2017, he has been investing in startups, helping startups. Now he has been helping startups and been on several boards of startups. And he's a director of Swan. Swan is recognized as a national leader in impact investing and also syndicating across investor groups on impact investment. Welcome, Juan. Please.
Thank you, Jesse.
Introduce yourself.
Thank you, Jesse. It's really good to be here. I appreciate the introduction, and I appreciate what you and your group are doing. I think it's so important for collaboration in this very important and as you said, very difficult space. I have some good news for the group that I'll share in a second after I round out my a little bit about my background, so you kind of get a sense of where I'm coming from. As Jesse said, I started out in sales and technology sales mostly in deep tech because I have an undergraduate degree in mechanical engineering. So I've always loved technology, especially deep technology. And as she said in 2017, 2016, 2017, I became an angel investor um, due to a number of factors. I was able to participate in a IPO from a previous company that I was an executive at, which was very exciting and fun. And then along with Bob Bridge was fundamental in launching and growing Swan Impact Network. And as Jesse said, Swan was started to invest in impact startups. So we had this idea, which was pretty novel in 2016, that we wanted to support early stage startups that were trying to make the world better. And so what that ended up meaning is that we supported startups in a number of different industries, including health tech, clean tech, education, supporting startups, and financial empowerment. Over the years, we have focused our investments. So about almost 3/4 of our investments from a dollar perspective have been in the climate space. So we become kind of climate experts over that time. And because of that, we also launched a venture capital fund where I'm a general partner called Semilla Climate Capital to continue that focus on climate. The strength of the network is exactly what Jesse's doing is bringing together like-minded people who are interested in working on this problem, but have different backgrounds and different experiences that they could bring to bear, not only in terms of evaluating startups, but also supporting those startups once they become part of our portfolio company, which is around, I think, almost 40 companies now in the portfolio. We get about 50 to 140 applicants per quarter, and we usually invest in 1 to 2 companies per quarter. And then I'll give you this little bit of good news, Jesse. I was at a climate summit, ClimateTech summit in Houston earlier this week. And the latest numbers that have come out in terms of the IRA is that the effect over the next 10 years, because it's not a capped amount, the latest projections is that it'll inject about $1.2 trillion of money into the climate tech sector. So that's really exciting.
Yeah, exactly. So I believe you see this time the so-called climate tech is like a clean tech 2.0. It's totally different with clean tech 1.0, like more than 1 decade ago, right?
That's right.
Please talk about what subsectors of climate tech have the most promising potential, and maybe some area are too crowded. What do you see?
Yeah, great question. Obviously, we're excited about climate tech as a whole, but as you're alluding to, there are a number of subsectors that we think, anyway, just from where we're sitting here in Central Texas, that we think are really promising. One of the things we think is overlooked is improved efficiency. I think there's still a lot of opportunity for making the different energy drains, for lack of a better term, or energy users in this world significantly more efficient. Things like even ICE engines, diesel engines, industrial processes, water processes, construction and building maintenance are all areas where we think there could be a significant amount of innovation in efficiency gains, and not only would that reduce greenhouse gases, but also generate a lot of financial value. So we're excited about that. So we think those are getting overlooked. We also like solutions that combine innovations in both hardware and software, which as investors give us 2 potential moats. We absolutely like a lot of the progress that's being made in big hardware solutions such as solar and wind. But we think adding intelligence with machine learning and AI and purpose-built algorithms gives it even more power. And then the last thing is an area that we are a little reluctant to invest in, but very, very excited about, and that is innovations around chemistry and material science, things that remove carbon and produce more sustainable products. We don't have a deep expertise in this area, but we rely on people like the people on the call today, people in our network who do have experience to help us evaluate those opportunities. But there's a lot of exciting things going there. And so if you're a burgeoning entrepreneur who has some experience in chemistry and materials, I would highly encourage you to think about making a startup in that area. Just really exciting stuff happening there. And in terms of overcrowding, and I think that's the right way to put it, because I think that there's great opportunities there for those companies, but it's just going to be more difficult, is things around battery chemistry and then carbon tracking software. We're seeing a lot of companies there, and it's becoming more and more difficult to differentiate yourself as an entrepreneur in those sectors.
Totally agree. Yeah. Thank you for the insight. And how do you identify and evaluate ClimateTech deals? Especially,
Yeah,
how do you do due diligence?
yeah, that's a really good question, and that's something that we're continuing to work on. But as you mentioned, we've been doing this for about 7 years now, so we have a pretty standard process, and it's probably not very different from what other established angel networks and venture capitalists use. So first of all, we see a lot of startups at events and accelerators and out in the community, which is great, and it's a great way to meet them. But we also establish obviously a website, so if people are interested. I think it's in your literature. Swan Impact Network. We have an intake form where we ask questions that you would expect to be asked. So that's also available in terms of finding them. And then the other thing is we have this broad network, just like you're doing here, of people who are in different parts of the world, different parts of the United States, different parts of industry, different points in their career, and we're always talking about what we're doing. And so they're always bringing us different potential startups. So that's how we find them. In terms of due diligence, that is really, really hard. So Bob Bridge, who's not on the call but very important, is a hardware specialist. He's been hardware for a long time. I was in software for a long time. So when we get those kinds of companies, and we feel really confident in terms of evaluating how they might do in the market, especially in a B2B scenario. But when they get outside of that, relatively narrow pathway, then we rely on experts, other folks in our network, just like you're doing here. And over the last 7 years, we built a network of over 80 investors, and then we have a number of different advisors who work with us and subject matter experts, including people at universities here in the Central Texas area who have a lot of expertise. So we rely on them to help us evaluate this company. So right now, I'm actually evaluating 2 water filtration companies, and I know nothing about water filtration. So I'm reaching out to folks. If anyone knows anything about water filtration, please send me a note. And we ask, the questions that you would expect to be asked. Once they get past that first screening, that they have a technology that works, and might make an impact in some factor of climate tech, greenhouse gas reduction, methane reduction, cleaner water, cleaner air, reusability, reduction in resource use, that sort of thing. Then we start drilling down into what is the impact that this might have on climate. And we think about impact in 2 different ways. One is, how broad is the impact? So how many people will be affected? And then how deep is the impact, right? So how much improvement we expect. And obviously, we're looking for a really good combination of both of those sorts of things. If we feel confident that there's a potential for that company to have that sort of impact, then we start looking at financials just like any other investor, right? So how compelling is the financial case to potential customers that that might buy whatever product or service is being offered? And then we also look at the team. How well does the team work together? How long have they worked together? Do they have complementary skill sets? Are they open to coaching? Are they willing to take in new information and make appropriate changes? But still, having said that, we also look for teams that are really committed um, to solving the problem that they're working on. We think that climate and impact investors in general are really good investments because they are committed to this problem, to solving this problem. So the last step in due diligence. So if we get through all of that, then we start looking at what does the deal structure look like. If we make an investment at the terms that they're suggesting, do we feel really confident that we'll make a good return for ourselves and other investors who are involved? If all these things line up, and there's a few more obviously that I left out, but in general, those at a high level, that's what we do. Then we make an investment.
Thank you. I just borrowed this picture from LinkedIn. I see ClimateTech startup because of their technology is usually deep tech or hard tech. So across this life cycle, there are more risk, seems more risk and need different fundings along the life cycle. Also, I remember Bob talk about it's about de-risking when you evaluate. So you know what are those risk factors. Could you talk a little bit more about what angels are looking at those risk factors and they understand the risk factors, especially in climate tech?
Yeah, that's a really good point. And it's something for folks on the call to know is that anytime you're investing as an angel or any early stage investing is highly, highly risky. And as you said, Jesse, climate has its own sort of risks. So there's a number of things that we look at in terms of de-risking the investment. And I think you and I talked about this before. One of the first things you can look at is do they have customers? Meaning, do they have a product that has already found product market fit and some acceptance in the market? That is usually a really good sign. It's not always enough, but it's a good sign. So it's something you want to look for, and probably not something you'll get a lot as an early stage investor. The other big thing, and I'm glad you brought up this chart, is this idea of government funding. It's another really great way of de-risking, especially climate tech, is do they have grants? Who are the granting bodies and what are they saying about this technology and the potential future? So we have an investment that has gotten some funding from Department of Energy. Really great opportunity for us and for them, to get non-equity funding, but also resources like national labs and that sort of thing. Another really good way of de-risking it, right? So they get expertise to help them develop their products essentially for free. So that's always a good way to do it. The other thing is doing the kind of thing, Jesse, that you're doing is, do they have other angel networks on their cap table that we have relationships with and that we value the way they make their investments? That's another good way to de-risk their investment. If they have strategic partnerships already, if they have a letter of intent or even a small investment from a potential acquirer or potential customer on their cap table, those are also really good signs in our estimation that some of the risk has been taken out. And then when you're doing your due diligence, as I said before, another way that you can de-risk it is, do they have someone on the team or someone on the board with some ownership stake, an equity stake, that has deep experience in whatever the hardest part of the technology is? That's another thing that de-risks a potential investment for us.
Some risk factors are not startups can control, like the ecosystem, the value chain. Can you talk about this and what are the strengths in the United States?
Yeah, so I'll talk about it generally. So absolutely, the probably the majority of the risks when you make an investment this early, an assessment of a company this early. A lot of the risks, perhaps the majority, are unknown. Right, they will happen sometime in the future. They're macro risk or market risks that haven't come to bear. So the very first thing you have to do to de-risk that is you have to have a significant amount of confidence in the founding team and their ability to take these new data points, these new challenges, these new obstacles, and either incorporate them into the go forward plan or work around them. So that's the first thing is you have to have confidence in the founding team's ability to manage those risks. And you know, part of that is during due diligence, have they managed risk before? What experience do they have with changing market conditions, and how they manage it? The other thing to do is, and I talk about this, we might talk about this a little further, is that their offering is so compelling, right? A lot of people talk about this duality between need to have and want to have. So if their offering, their solution is so compelling and solves such an important problem for a number of customers, that even if macro conditions don't change, then they'll still want to buy this product. And then I'll briefly touch on what you said around the U.S. and risk conditions. We mostly invest in the United States because a lot of the risks we feel, and partly it's because we have some ignorance on the global scale, but we feel a lot of the governmental risk, market risk, supply chain risk, they're minimized in the U.S. as much as possible. Now, having said that, you bring up a good point, Jesse, that we're living in a very global world. So one of the assessments that you have to make, and we usually make when we're looking at, especially hard tech that has a lot of different components, is how global is your supply chain, and do you have backups for your critical parts should something happen in whatever part of the world you're currently getting those parts from. And that absolutely important assessment to make. Having duplicates in the supply chain is a great ask, but it's sometimes not realistic in a very, very early stages of a startup, but it's something you should definitely consider as you make an investment.
Yeah, totally. And the other possible factor is the market demand, the adoption readiness. Is the ecosystem partners ready to adopt this new technology? So this to the next question. Please talk about your portfolio building strategy, especially you are building your fund now to diversify your risk.
Happy to do it. So the very first thing is, I'm glad you brought up this question. If you are going to be an investor, whether it's a venture capitalist or an angel or even just a retail investor, having a portfolio approach is a must. You have to really think about, how do I spread my risk out? Because of what Jesse and I just discussed, is that a lot of this risk is unknown. And so you have to spread your risk out as much as possible. So I highly encourage everyone to think about, and this is how we're thinking about it, how do I make 10 to 20 investments in the next 3 to 4 years, 3 to 5 years, so that if a couple of those companies fail, and they will, you'll still have some opportunity for upside. So when we think about portfolio construction, we think about a couple of things. One is making sure that we have different sectors. So our first investment in the venture capital fund was a diesel conversion to clean diesel. So our next investment is almost certainly not going to be in the transportation sector, right? So we're looking for other companies in other sectors so that we have some diversity. The other thing to think about in terms of diversifying your portfolio is geography and the types of people you invest in. We really strongly believe in supporting underrepresented founders, so women and people of color as leadership teams. Not only is it, we think, important just in general as humans, but it turns out that financial analysis shows that those teams tend to overperform. So I would encourage you to think about that as part of your mix when you're building a portfolio. The last thing I would say about portfolio is it's also thinking about general risks. So absolutely, you're right. Most of the opportunities in climate tech are deep tech, but there's a lot of other opportunities, as I said before, that are lower hanging fruit where the tech is not novel, but the application and the go-to-market strategies might be novel. And so investing in those kind of companies also de-risks some of it for us because in our first investment, it is a deep tech and there's a lot of technical risk. So if we can find a couple other companies that don't have quite the deep technical risk, that are more about, as I said, applications and go-to-market strategies, then that'll help us de-risk our strategy as well.
Yeah, thank you. I'd like to open the floor for guests to ask questions. But I can do a little bit introduction about our next two sessions. I believe these two are most important questions. The next week, next Friday, we will talk about capitalization and financing, mostly about funding sources and gaps for climate tech startups and project business and partnership models that could decide or impact the capital intensity and the capitalization plan. Also include when to exit and how. So we have Paul from Creative Forum and Karen from he's actually head of finance at Visa. And the next one after next is from Houston experts, talk about techno-economics analysis, variables in unit economics of climate tech and how to do DD, and how can climate tech startups sell to large enterprises and shorten the sales cycle. So we are on top of half hour. I'd like to open the floor for questions. So maybe we will.
I have a question.
Yeah, thank you.
Hi, Juan. Thanks for the great insights about climate tech investing and how it kind of differs from the rest of it. Could you also touch upon the fact that climate tech companies need a lot of capital investments and strategies for the startups to fork out that portion from the VC investable high growth portion?
Yeah, that's absolutely right. A lot, not all, but a lot of climate tech companies require a significant amount of capital to get to achieve results. You're absolutely right about that. I think there's three things to think about. Number one is approach venture capitalists when the time is right. Approach them, those that are interested in climate tech and understand climate tech, so they'll know it won't be a surprise to them how much capital you need, right? And they'll understand how to work with you. Number two is, as a climate tech entrepreneur, you got to think about putting together a consortium to fill out your rounds. And that consortium may include things like venture capital, government funding, and even some PE players who are more used to project type financing, long-term dollars, and different capital structures. So that would be number 3 and number 2. And then the third thing I would think about is early in your capital raise, as we talked about here earlier with Jesse, is de-risking by finding these government partners is so key. If you know that the solution set you're going after is going to require a lot of time and a lot of capital, very, very important to start out as much as you can with non-dilutive government funding.